So good day everyone, I'm Jana Patricia M. Montaño, and today I will be reporting on Chapter 4 of our income taxation subject, Income Taxation of Corporation. Specifically, our report covers the foundational topics of this chapter: the nature and legal definition of a corporation for tax purposes, the basis of how their income is taxed, the classification of corporation under the National Internal Revenue Code, the definition of a domestic corporation, and finally, how domestic corporations are further classified for tax purposes. These topics may sound technical at first, but by the end of this report, I hope you will see why they are absolutely essential, not just for passing our exam, but also our careers as future business and finance professionals. Before we begin, let us look at the specific learning objectives that will guide our report today. Our topic covers 6 key objectives. First, to know the nature of corporation for tax purposes. Second, to understand the basis of taxation of their income. Third, to identify how corporations are classified under the NIRC. Fourth, to define what a domestic corporation is. Fifth, to understand why classifying corporation matters. And sixth, to distinguish between ordinary and special domestic corporation. These 6 objectives form the complete scope of our report, from definition to classification to the practical distinction between types of domestic corporation. What is a corporation for tax purposes? In everyday business language, a corporation is a separate legal entity registered with the Securities and Exchange Commission. But under the NIRC, our tax law, the definition is much broader. Section 22B of the NRC says that corporation includes partnership no matter how created or organized, joint stock companies, joint account, which we call cuentas en participación in Spanish, and association and insurance companies. As you can see, the law does not limit itself to formally registered corporation. Any entity that earns profit in a corporate-like manner may be taxed as a corporation. However, the law also provides 2 important exclusions. The first is the General Professional Partnership, or the GPPS. These are the partnership formed by licensed professionals like a law firm, an accounting firm, or a medical clinic to practice their common profession. They are excluded because their individual partners are already subject to personal income tax on their respective shares. Taxing the partnership separately would result in double taxation, which would be unfair. The second exclusion is joint ventures or consortia, formed for construction projects or energy operation, like petroleum, coal, or geothermal under a government service contract. This exclusion is a deliberate policy decision to encourage investment in infrastructure and energy. Now that we know what a corporation is under the tax law, let us ask, how is it taxed? Or more precisely, on what income is it taxed? The taxability of a corporation's income depends on 2 key factors. So factor 1 is the corporation domestic or foreign. A domestic corporation is one organized under Philippine law. A foreign corporation is one organized under foreign law. Factor 2, if the corporation is foreign, is it a resident or a non-resident? A resident foreign corporation is a foreign corporation that is engaged in trade or business in the Philippines, meaning it has a permanent establishment here. A non-resident foreign corporation has no such establishment. So why does this matter? Because it determines the scope of income that is taxed. Looking at the table on our slide, the domestic corporations are taxed on their worldwide income. So meaning all their income, whether earned here in the Philippines or abroad. Resident foreign corporations are taxed only on income from Philippine sources. And non-resident foreign corporations are also taxed only on Philippine source income, but with no deductions allowed. They are taxed on gross income. So the broadest tax obligations falls on domestic corporation, which is why understanding what makes a corporation domestic is so important. So the NRC classifies corporation into 3 broad categories. Number 1, domestic corporations. So these are organized and exist under Philippine law. And as we just discussed, they are taxed on worldwide income. Number 2 is foreign corporation. These are organized under the laws of a foreign country. They are further divided into resident foreign corporations, those with a business presence in the Philippines, and non-resident foreign corporations, those without one. The number 3 is unregistered partnership and other entities like corporation. This is very important anti-avoidance provision. Without this rule, people could form informal association to carry on a business and avoid all income tax because they are neither individual nor formal corporation. The NIRC closes this loophole by treating them as corporation for tax purposes. A classic example would be two or more individuals who pool resources and share profit in a commercial venture without formally incorporating or registering as a partnership. And under the NIRC, this would still be treated as a taxable corporation. The Domestic Corporation Section 22C of the NIRC defines a domestic corporation simply as a corporation create or organized in the Philippines or under its law. The key criterion here, and this is something you must absolutely remember, is the place of incorporation. It does not matter who the owners are, it does not matter where the business operates. What matters is, was it incorporated under Philippine law? Let me give you 3 scenarios to illustrate. Scenario number 1, a corporation that is 100% owned by foreign national, but incorporated in the Philippines. So, is it domestic? Yes, because it was organized under Philippine law. Scenario 2, a corporation incorporated in the Philippines but all its income comes from abroad. So is it taxable on that foreign income? Yes, because domestic corporations are taxed on a worldwide income. Scenario 3, a corporation incorporated in the Philippines, must it be registered with a SEC? Yes, because under the revised corporation code RA 11232, SEC registration is required for Philippine corporations. This aligns corporate law with tax law. Next is classification of domestic corporation. Now that we come to the classification that is most critical for tax computation, the division of domestic corporation into ordinary and special types. So, ordinary domestic corporation are essentially the default category. If a domestic corporation does not qualify as a special corporation, it is ordinary. These corporations are subject to the regular corporate income tax rate, which is under the CREATE Act is now 25% reduced from the old rate of 30%. However, there is a lower rate of 20% available for small domestic corporations, specifically those with net taxable income not exceeding 5 million pesos and total asset not exceeding 100 million pesos including the value of land. Example of ordinary domestic corporation include manufacturing companies, retail businesses, technology firms, service providers. Essentially, most of the corporations that operate commercially, the special domestic corporation are those given special tax treatment, either a different tax rate, a different tax base, or even a full exemption from income tax. This special treatment exists because of a policy reason to support education, healthcare, priority sectors, or non-profit activities. Examples include proprietary educational institutions and non-profit hospitals, which are taxed at only 10% on net taxable income. Next is government-owned and controlled corporation or GOCs, banks under the foreign currency deposit system, which have special rates on interest from foreign currency transactions, and non-stock non-profit organizations, which are generally exempt from income tax on income they earn in pursuit of their exempt purposes. The key takeaway is this: knowing whether a corporation is ordinary or special determines everything about how its tax is computed. Why classification matters? So first is applicable tax rate. Getting the classification wrong means computing tax at the wrong rate. Applying 25% to a corporation that should be taxed 10% or vice versa leads to either a deficiency or an overpayment. Second, the tax base used. Most corporations compute tax on net taxable income, but some special corporations use gross receipt or other bases. The formula itself is different. Using the wrong formula makes the entire computation incorrect. Third, compliance risk. The NRC imposes surcharge of 25% to 50% and interest of 12% per annum on tax deficiencies. For large corporations, these penalties can run into millions of pesos. This classification is one of the most common routes of tax deficiencies. Fourth, professional relevance. As future accountants, financial managers, and business professionals, we will encounter situations where we need to advise clients or our organization on their tax classification. This is a basic professional competency, not an advanced one. To simply put, correct classification is the foundation of correct taxation. Everything else, computation, filings, and payment depend on getting this right. So in conclusion, the foundation concepts we covered today are not just textbook definition to be memorized and forgotten after the exam. Understanding who qualifies as a corporation under the NRC, or what income they are taxed, or how they are classified, and what makes a corporation domestic or ordinary or special, this form the backbone of every corporate tax decision a business will ever make. Whether we become accountants, financial managers, business owners, or consultants, this knowledge is the foundation we will return to again and again. In taxation, getting the foundation right means everything built on top of it will stand. So thank you for listening, and I hope this report has given you the clearer picture of how corporations are treated
under the Philippine income tax system.